Welcome to your commercial-free, uninterrupted investment show, sponsored by the SEC-registered investment firm, Wilsey Asset Management, a fiduciary firm owned and operated by President Brent Wilsey, who has been putting clients' investment needs first for over 40 years. The Smart Investing Show has been giving unbiased financial information for over 27 years on local radio stations right here in San Diego, providing you with fundamental analysis on stocks and investments you want to know about. Now, here are your hosts, Brent and Chase Wilsey.
Well, hello and welcome to the Smart Investing Show. I'm Brent Wilsey, president of Wilsey Asset Management. With me is Chase Wilsey, vice president at Wilsey Asset Management. And before we get into the finance and the economy and so forth, Chase is the linebacker coach at Poway High. So I got to find out. I didn't talk to him yet about this. We talked about other things. But you guys win last night, or how'd it go?
Yeah, we won. It was an ugly win, but we played the other Titans down in Eastlake, and let's see, I think it was 14-6 was the varsity score. JV score was 36-6. So we didn't play up to the best of our ability, but we won, which is what matters at the end of the day. So it was still fun, but you know, there's a lot of mental mistakes, penalties, and fumbles and turnovers, which just as a coach, you don't like to see.
Yeah, and that's when I was wondering, what's an ugly win? It's when they make a lot of mistakes and fumbles and so forth, but you still win.
And it reminds me of the Chargers several years ago where they had a great roster and they would always play down to the opponent. And I mean, because Eastlake had a lot of injuries and they weren't having a lot of their starters there. So, I mean, they weren't at full force when we were, right. And we just played down. But, hey, we'll move on.
You got 2 wins now under the belt there. And the linebackers did okay.
They did, They did well.
Good. All right, well, let's talk about streaming services. We knew the day was coming when streaming would have bigger viewership than cable TV. It officially happened this past July. Streaming services accounted for 34.8% of total U.S. TV viewing, compared with cable at 34.4%. Now, the 34.8% streaming services viewing climbed dramatically from 23% 1 year earlier. Now, we may see similar numbers in August, but in September, we may see a switch back to cable as major networks launch new seasons and new show. Streaming businesses are still losing hundreds of millions of dollars as witnessed in the latest quarter.
And part of this is because of the cost to create new content. It is so easy to switch from one streaming company after a specific show or series is over to another streaming company. Remember how difficult it was when you had to switch cable companies? You had to have a cable guy come out for an appointment that was set a week ago and then wait half a day at home for them to show up to switch your service. And yeah, you just got that giant block of time, you know. It's like, gosh, I hope they come early. Nope, it always seems to be at the later part of that block of time. But now you can just switch your streaming service, just sitting on your couch in the comfort of your living room. I think the winner long-term in the streaming services will be those that have the most titles in their libraries, along with the best studios to produce new content in.
And this is something that, you know, I think Netflix has tried, but it's very expensive to get caught up to, you know, the bigger studios because they already have content. And I have Netflix, and I've watched some of the shows. Some of them, I just can't keep watching them because I think they're filmed in Korea or Japan or something. It just irritates me because their lips don't match.
They're dubbed over. Yeah.
They're dubbed over. And just irritates me because I'm watching that. I don't know what's going on because like it's distracting is what it actually is. So
yeah, and I don't necessarily think it's the most content either. I guess I want to say the most quality content shows because that's one thing that does irritate me a little bit with Netflix. And I don't go to Netflix as much as I used to with all the new streaming services because there's so much there. But in my opinion, there's so much crap where you're like digging through and it's like, that was terrible. And it makes me want to go to that service even less.
Yeah.
So then I know, like I go to HBO quite a bit and there's some really good shows there. And they seem to have less, but more quality.
Which one is that?
HBO.
HBO. Yeah.
And that is something I know that even their new CEO, David Zaslav, is really focused on. He's been canceling shows, he's been canceling movies, and I think he's really concerned about producing well-branded content that makes people want to come back, because you don't want a consumer to go watch a show and it's like, that sucks. And then it makes you, as I said with Netflix, I actually can't remember the last time I went to Netflix.
Really?
Yeah.
Wow. Yeah, my HBO is down, and my Paramount is down. Something happened. I got to go back on. I will say, and again, I shouldn't complain because I don't have the cable guy come out, but still I got to sit there and you got to do it, with the screen where you
Takes you 20 minutes.
20 minutes, yeah. And just like, I'll watch cable TV.
Well, it's so funny because there's so much of a generational difference, obviously, where we just moved into the new office, and you're like, I don't know, should we get cable? I'm like, why would we get cable? Like, it's like we could just get a Roku and plug it in, and if we don't want it, we can cancel it rather than having the cable guy come out, sign a year-long contract. And to me, nowadays with the YouTube TV, the Sling TV, there's like Hulu has their own TV plan. I think there's a couple more that I may be missing, but it has all the cable channels bundled into the streaming service. It's like, why would you get cable?
Yeah, and I kind of get that now. Like, okay, so we didn't have the cable guy come out. We got 2 Roku TVs. I don't know if they're working or not.
They're working.
They're working okay. But the thing is that with Netflix, I know they came. I think they hit 600 at one point, I believe, or close to it.
Yeah.
And they rebounded from, I think, 170 back up to 229. I still don't think that they're worth that level there, because competition is so heavy, and you're right, the content is just not that great on Netflix. They have some good things. Actually, I did see a movie I want to watch, I think tonight from there, but it's not as good as I think as the Paramounts, the Disneys, and maybe the HBO ones. So
$799.
Wow.
That's what Netflix hit.
Wow, I didn't know it was that high. Yeah, so... And there's someone that paid $7.99 for it, saying it's going to come back.
Yeah.
Well, let's talk about the student loans. This has been very controversial, so we'll still talk about it. But the news from President Biden around student loan debt is, well, in our opinion, quite frankly, idiotic and dangerous in our opinion. To begin with, we are delaying payments on student loan debt again to the end of December 31st because people have not had enough time to prepare. What about the last 2+ years of us not making payments? Also, the $10,000 worth of forgiveness is estimated to cost another $300 billion. And in an inflationary environment, the type of loose spending we have seen does nothing to help reduce the inflation burden for the average consumer. And in fact, we believe likely fuels higher inflation.
Yeah, and it is also just unfair to the people that have diligently paid off their debt, opted to join the military to receive the GI Bill, or just avoided college due to the high cost. The biggest problem here is this does absolutely nothing to solve the root cause of the problem, and in fact may just fuel the cost of college higher. Students borrowing money today will continue to rack up debt and will likely want another handout in just a few years. I don't see how this does our economy and, quite frankly, our country any good either. And the thing that they're saying is, after this debt's forgiven, I believe their estimate is within the next 5 years, it's going to be right back to where we were in terms of the amount of student loan debt that's out there in the country. So again, what happens then?
And I was wondering, now is that going to be new students, or is that going to be students that, well, I can go back again and change my degree?
Maybe both.
Maybe, but could be both. And the thing is, you're right. You're setting a precedent that, well, they forgave that one back in 2022. It's now 2027. Well, what about me now? They should do it again. So I have heard, and I'm hoping it goes this direction, that it goes to the courts, because perhaps this is not a legal thing to do because the president doesn't have the right to forgive contracts. I know they've used COVID and some other things to try to do that, but I would like to see it go through the court system and see if it's really legal or not, because it seems wrong that the president can just sign his name and, oh, there goes $300 billion more.
Well, they're saying it would be the most expensive executive action.
Really?
Yeah. I mean, there's estimates that it's going to be $500 billion.
Yeah, because actually we said it's $10,000, but I think if you had a Pell Grant, it could be as much as $20,000.
And I don't know how much you know about a Pell Grant, but
Pell Grant was just money given to you.
Yeah, it's free money. So it's people that already got free money are getting even more free money. And
right.
It's really, again, dangerous. And we've taken a lot of flack on this on Facebook, and people, kind of saying, oh, well, you don't get it. It's going to be really great to stimulate the economy. Our economy doesn't need stimulation right now. Our economy needs supply.
Right.
That's what we need. We need the supply to combat inflation. More stimulation is exactly what is going to lead to more inflation. And I mean, it is frustrating. As I said, I know one of our coworkers, her son had, I think it was around $30,000 of student loan debt, and he paid that all off within a year.
Yeah.
Well, he should have waited. Should have waited. And my fiance and I both have student loan debt. Well, we refinanced.
Right.
Because that was a smart decision, a smart financial decision to make. Well, that's going to end up costing us probably about $20,000 had we stayed on the government debt.
Yep.
And it is just frustrating when you make the right moves and you do the right things. And I saw a couple as well. I believe they paid off over $150,000 in student loan debt in 2 years. Sucks for them. They should have waited.
Should have waited. Yeah, and it's just a shame because again, I think it also does not teach financial responsibility, and people want actions for free and so forth. Investing is not that way, and we've seen that with meme stocks. We've seen that with many different things, and we're teaching another wrong lesson to young people. Like, well, you know what? We're just going to pay it off for you. So no discipline there. Same thing in investing. Well, I lost money with investing. Well, the government's going to pay me back. I'm just. I get a little bit disappointed on the direction things are going. We're not teaching young people the right lessons.
And again, my big concern here is, number one, the inflation, and number two, I really think it's going to raise the cost of college. And so all that's going to happen is that estimate for 5 years to get back to where we're at in student loan debt. It could be faster if colleges raise their costs. It's kind of like I saw this thing the other day with the whole EV tax credit.
Right.
It's like, I think, $7,500. And the Ford Mustang Mach-E is now raising their price to $8,700.
I know.
And it's not just because they're getting the tax credit, but it's because the cost of lithium and the battery component, it has gone up. So to make that profitable for, they have to raise the price. But it is just kind of funny. It's like, okay, we're going to get a $7,500. Okay, well, all right, well, we'll just raise our price now, and people can still afford it because they get the tax credit.
Yeah.
And that's my concern here with colleges. Colleges are going to say, oh, well, they got their student loan debt forgiven, so let's increase the cost of college.
Well, and I think college has done that for years. I wrote in posts on that years ago that the reason why college education is so high because they know they can raise it because the government will step in and they'll fill that void for people. They'll give them loans, grants, or something else. The demand side is so high because the money is always going to be there.
Yeah. No
one's really paying for it, so therefore the government's paying for it. University and colleges know that. Like, yeah, we can increase tuition 10% because we know it's not going to. Normally, as a business, for something like a business, you increase your prices 10%, you're going to generally lose some customers. But that's not going to happen in college because you raise your tuition 10%. Oh, that's okay. The government will kick in the money, and we can raise another 10% next year. I mean, it's on this cycle that needs to be broken. And I've often said, you don't need to go to college. Yeah. I mean, I talked to one guy, actually, well, he's actually on our Facebook who we know, and he said, I didn't go to college. I'm doing fine. But what really irritates me, I didn't go to college, but yet I got to pay for somebody else's who went to college and is not doing fine. Well, yeah. So.
Yeah, I mean, we've talked to a lot of successful business owners, and, they didn't go to college, and, there's great trades out there. We always talk about the JC route or the community college route. I mean, if you're worried about the cost of it and taking on debt, that is a great alternative. I mean, there's just so many different things you can do now. And I say I studied business and finance. I don't think I needed to study business, to be quite frank with you. Right. I needed to study finance because that is something that is a little bit more book heavy.
Right.
But the business, I talked to a gentleman that actually runs a business. He's like, you don't learn about business in business school. You learn about business when you actually run the business because that's when the real lessons come in.
Well, and I will say, I went to National University, I guess now, probably 35 years ago. But it was different then. I've not been in a National University class in a long time. But actually, they had professors that taught at night that actually ran businesses. So what I really learned a lot from them was what they were doing in their businesses. They bring in real life stories. Unfortunately, you go to normal college, you get a professor who's not really running a business, so he doesn't bring in real life stories, have case studies from the books. But I always say my successes come from National University, from those professors who would bring in the day of, the accounting firm, that's what we went through, or the tax side, or the marketing side. It was just the best education I could have got at National University. I don't know if they do it the same way. I think they still do.
Well, unfortunately, it's just not. College is an investment, but people don't view it that way.
Right.
Where, if you're going to be an engineer, yeah, you probably need to go to college. That's some pretty complex stuff. A doctor, yes. It's things like that, but you're going to have a return there.
Right.
Because the salaries are much higher. But if you're going to study something and there's no return, well, what's going to happen is if you stop going into those those fields and those education pieces, well, the demand's going to drop, and colleges are either going to have to cut classes, or they're going to have to lower the tuition there, or do something, because there's just no demand.
Right.
You can't just keep creating this falsehood of demand. That's what causes the price to go up, because colleges know they can charge for it.
And, you know, we always talk about trade schools and so forth. You always think of plumbers, electricians, but there's other ones as well. My daughter's a paralegal. That did not take 4 years to get that, you know, paralegal certificate or whatever they get. Court reporters. I mean, there's so many other things you can do that will make money, as opposed to spending 4 years in college and get out like, okay, what do I do now? X-ray technicians. I mean, I don't know what they make, but I mean, there's a lot of jobs you can learn that are not just a plumber or carpenter, that are, we'll call white-collar jobs.
Yeah.
So let's move on to the Federal Reserve. Have been thinking both the stock and bond markets were taking the Federal Reserve and its interest rates policy too lightly. Powell has now made his intentions clear, making some strong comments like, while higher interest rates, slower growth, and softer labor market conditions will bring down inflation, they'll also bring some pain to households and businesses.
These are the unfortunate costs of reducing inflation, but a failure to restore price stability would mean far greater pain. Unfortunately, I don't believe the battle with inflation is over, and I believe interest rates will continue to rise.
Yeah, and the Fed's preferred measure for inflation, the Personal Consumption Expenditures Price Index, PCE, showed inflation easing somewhat as the month of July. The index climbed 6.3% year over year versus the 6.8% gain in the month of June.
And while inflation is easing, it is still well above the 2% level the Fed targets. This is why I believe they will continue to move forward again with that quantitative tightening and the interest rate hikes. We're still optimistic that we will see inflation ease as we exit the year, but there is still a way to go before inflation is no longer a concern. And this is something that again, we kind of talked about here, is the NASDAQ and the S&P and even the Dow. They all got crushed yesterday. And it was kind of funny because people anticipated Powell was going to be hawkish, and then he was hawkish. And oh my gosh, he was hawkish.
He was hawkish.
But if you looked at the market, and it's particularly the growth stocks, the last month and a half, 2 months, the growth stocks have done tremendously well. And it's like, why are they doing well? And the 10-year note has not done that well in terms of, well, actually, the 10-year note has done well if you hold it, because the yield has fallen somewhat.
Right.
So the price of the bond went up, but not the yield. And we were sitting there saying, why is this happening?
Right.
It just wasn't making much sense. And sure enough, I just really think that the people, investors, and the markets were discounting, I think, how hawkish the Fed was going to be, and they've really been upfront about what their plan is.
And we've talked here on the show, and our posts, and our newsletter, which, by the way, if you like what these topics we're talking about, want to hear more about them, or other topics we have as well that may be of interest to you, you can go to our website, smartinvesting2000.com. That's smartinvesting2000.com. Right in the middle, you'll see the newsletter button. Just click on that. And we talked in the newsletter things about Bed Bath & Beyond, what's going on with that, cell phone subscriptions, what's going on with that, other topics, electric vehicles, Tesla. So if you want the free newsletter, go to our website, smartinvesting2000.com. Just click on that, and you'll begin receiving the free newsletter. But what I was going to say, too, is that we have talked about that with inflation, we do see it coming down to 5 or 6% by the end of the year, which is better than we're at now. But it doesn't mean it's going to stop with the Fed, because their target is, I think, like 2 to 3%. So
I think it's 2.
Two. Not, I'm being nice, I guess, it's 3, but 2. So, and you know, actually, in reality, that's pretty low, 2%. So maybe they will forgive on that a little bit. But what we're seeing is that the supply side is improving somewhat. Now, the demand side has come down somewhat, but if these two things can happen, that's why we feel by the end of the year we could see inflation at 5 to 6%, better than now. But it doesn't mean, okay, game's over, let's go on. No, there'll still be more to deal with next year.
Yeah, and there's two kind of things that I look at here. Number one is the problem with fiscal and monetary policy is our fiscal policy right now is being very accommodative,
right,
which is, again, flooding the markets, the economy with money. Well, the Fed can continue to raise interest rates, but if the fiscal side of the equation is continue to push money out into the economy, the Fed's going to continue to have to raise this interest rates even further to combat the new inflation that's being created by the money coming out. The other thing, too, that I find quite interesting is a lot of times the people, I think the Fed's job is just the labor market and, making sure the economy is running well. The price stability is a factor that Powell's focused a lot on lately that is so important, because you talk about if you have runaway inflation, you really lose kind of trust in the U.S. dollar, which is a very dangerous place to be in. And in his speech yesterday, Powell referenced the 70s and 80s, and he said we don't want to have another Volcker-type incident where in the 70s it's like, we'll just kind of let inflation go and we won't be too aggressive. And then all of a sudden Volcker had to step in and force a recession. And I think he raised the Fed's funds rate to, wasn't it like 15, 18? It was a crazy high amount to tamp down that economy and pull demand out of the market, because otherwise they wouldn't have controlled inflation.
Right. And we want that strong dollar within reason, because also a strong dollar does hurt our exports, because then they're not as attractive to the people. But there's so many things that rely on the dollar. Oil is still measured in dollars and so forth. So you've got to have that stability of the country. And that comes that you've got to cut inflation now to keep things from getting out of hand down the road. And I think we can do it. I mean, and again, we did a post yesterday too, I believe, or it's going to be next week. I forget when it's going to show up, about the employment still looking strong, still looking good. I mean, and it's not just these it's a low-paying jobs. It is not. I mean, healthcare was up, financial and professional is up. So a lot of good things still there on the job market, which I think will prevent a major recession. And I think it'll be hopefully a mild recession that you really don't realize you're in a recession, except that you see it talked about on TV. So.
Yeah, well, I think we are in a recession technically, but
well, technically we are. But I mean, a recession is when your neighbor loses their job. That's a recession. When you lose your job, it's a depression. I don't know of anybody that has lost their job. Do you?
Long pause, but not everybody that I talk to on a regular basis that's in family, friends. No.
Yeah, and see, that helps, because when you have a job, you may be cautious on what you spend, but you still spend, and especially if you believe that job is secure, like you don't feel like you're going to lose your job. Now, if you feel like, oh my gosh, there's mass layoffs going off, and I think Ford laid off 3,000 people. Oh my gosh, that's a lot of people. Their employment numbers, I think, are 181,000 people. So it's 1% of the workforce. And it's just, we're not that position. We watch very closely. That's why, again, I recommend the newsletter, the posts, and so forth, because we watch everything we can on the job market, because that's important. All right, phone numbers. I need to get the phone numbers here. We're talking. I forgot to give them out. You want to get through for that unbiased, no strings attached, fundamental opinion about what you want to talk about. Give us a call here at 833-288-0973. Again, that's 833-288-0973. And since we got no calls, let's talk about Bed Bath & Beyond, because I hate to say it, but I really don't feel bad for these meme investors that are getting hammered the past few days. Traders in Bed Bath & Beyond saw shares fall more than 40% last Friday, and they were down 60% if you bought last Wednesday morning. All over the board on this, and I think I didn't check it on this past Friday, but I think it was like around $10, $11 a share, down from, 34.
Yeah, I mean, it's just dangerous, and we talked about this on the show a little bit last week, but it is just something that we look at with Ryan Cohen, kind of had led this meme hype, and the reason the stock crashed because he fully exited his position, and he definitely capitalized off that small investor, unfortunately.
Yeah, and that's something that you have to be aware of. And that is what I call a true gambling chip. You know, you and also too, it's the there's a theory for it.
Greater fool theory.
Greater fool theory. Yeah, you're buying it, hoping that somebody will buy it at a higher price than you, and that's all that's going on. And when this billionaire pulled out, it's like, well, wait a minute, he's not supposed to. That's not playing the game right. He's got to keep buying more. And he said, I think he made $60 million or something off it.
Yeah.
It's just. Everybody wants the easy way to invest, and there is not. I'm sorry. We've talked many times we in our presentation with new clients coming in, we spend 10, 15, 20 hours of research before we say, yes, this is a business we want to buy. And it might take us a week, 2 weeks, month, 2 months before we say, yes, we want to buy this business. So it's not a quick thing. It'd be so easy like, oh, yeah, let's buy Bed Bath & Beyond. It's going to go up 10% tomorrow.
Oh, and that's a hard thing, too, is we try and reduce the risk as much as we can.
Right.
And we always tell people still, we're wrong sometimes.
Yeah.
And that's one thing that you need to realize as an investor is you're still going to have companies that you do all the research and they are going to go down. But not 60% in a few days.
Right.
I mean, that's what happens when you gamble. And, that's why it is so important when you talk about building a good portfolio, diversified portfolio of different businesses, is you have to understand there's going to be times that are going to be difficult for the companies that you own. And people don't like to hear that. And they say, oh, well, you were wrong on that one company. Yes, but we were right on the other 15 companies.
Right, right.
And it's a hard thing for a lot of investors to grasp is they don't want to have that loss. And it's kind of funny sometimes people say, I'm just going to do ETFs or mutual funds. Well, if you actually break apart the mutual funds and ETFs, there's a lot of losers.
There are.
Too. So it's something that we try and educate people on, and we do this, and we're still consistently learning different things as time evolves. But that's one thing that you can't predict the future, unfortunately. There's going to be a situation like COVID where how are we going to know that was going to happen? And retailers were going to just get absolutely crushed. And retail was struggling before COVID, but the COVID situation accelerated those losses dramatically and forced a lot of retail companies out of business. So it's investing stuff is what we always tell people.
Yeah, and I tell people, I've been saying this for 30 years, I'm probably wrong a third of the time. But being wrong a third of the time, and again, I'm talking longer term, short term. Short term, yeah, you're going to be wrong a third of the time. But if you're patient, you bought good companies. We got a company in our portfolio right now that we're not very happy with, but we're going to wait another 2 years, 3 years because of what the management's doing and what's taking to get around that. You can make your returns much better, but you can't panic and say, oh, I bought this company and I bought it, at 100. Now it's at 80. I've lost 20%. I'm going to sell. Maybe you should buy more of that business based on what the business is. And this is where investing really comes through longer term, not shorter term, and it's just something that you can't look at investing for a year or two. So, all right, well, let's go to the phones here. Phone number is 833-288-0973. Again, that's 833-288-0973. Let's go up to Oceanside and speak with Tim. Tim, you're on the Smart Investor with Brent Chase. How can we help you?
Good morning, gentlemen. I listen to your show whenever I can, and I love it.
Well, thank you.
Got a question. I got a comment and a question. My comment is on the streaming. Do you think the reason I started getting into streaming 6 to 9 months ago was the streaming companies was because I knew that professional sports was going to dive into it head over heels. Do you think that has anything to do with the percentages where they passed cable this month? And if professional sports stays in the streaming market, I think the numbers are going to continue to grow. I don't think cable will ever come back.
Yeah, that's a good point because you're right. Sports are starting to get into streaming, and we also too like the right streaming companies going forward as well. But I think it's a combination of that, and I think sports coming on to streaming could be very beneficial.
Well, and it is very interesting as well. I mean, the big one I'm watching is the NFL rights, and I still like the NFL. I mean, there was obviously all that controversy so a few years ago, but I still love football, so I watch it. And it was the NFL Sunday Ticket. And I remember years ago, the only way you could get Sunday Ticket was you had to get the satellite.
Oh, that's right.
TV installed. but now they have a package that, again, it's a streaming right. So my point being there is different ways that it's evolving. And I do think you're right there, Tim. That is going to be something interesting to watch is one of the big players going to be able to scoop up Sunday Ticket. And rumor has it right now it's going to be Apple. That they're the front runner there for the NFL rights.
I thought it was going to be Amazon.
Yeah, and they're in the mix as well, and there's a couple of Disney's in there, obviously with ESPN, but it's going to be interesting to see. I mean, that is such an expensive contract that like Apple's service right now takes $4.99. They would have to jack that up or offer a separate service because there's no way you can offset that.
Well, doesn't Paramount that owns CBS, don't they have some football on there? How do they do that?
Yeah, that's the hard thing is the NFL rights are so segmented where like you get some day games, some night games. The Sunday Ticket is out of market games. Right. So the CBS and the Fox are in market games. Right. For particular time frames. So the NFL has been able to segment it so many different ways. I don't know as much about the other sports leagues, to be quite frank with you, but I know that's how the NFL works. But I know personally that once the NFL is off DirecTV, there's no reason for me to keep using them.
Yeah, yeah. Well, you still have DirecTV?
Well, yeah, I have DirecTV Stream actually,
Yeah.
but
Okay. But
and another type of streaming service. Yeah.
yeah. So Tim, I mean, I think it is changing that direction, and there's no doubt like streaming is the way of the future, and I think it's just going more. And one thing that I think is going to be difficult for them is the news side. But streaming is just it's even I stream now. I'm an old guy. I start streaming.
And I do wonder as well, is there's now going to be so much competition, is it going to be overbid? Where people, and especially now we talked about how easy it is to switch streaming, are they going to start using sports as loss leaders, and they're not going to be able to sell enough advertising to offset the cost? I mean, it is something that I wonder could go too far perhaps in terms of the bidding, because I know that the cost of these sports leagues has skyrocketed. I know like Paramount, and there's another one, they bid on the European soccer rights, and very curious to see how they utilize those with the streaming services.
And there are some streaming services companies that are actually profitable, that are actually making money. So that's where I'd want to be at, not the ones not making money. So,
right. And I think the ones that get into the sports and the news, it solves the problem for content. You'll always have content in live sports and live news.
Right, which it does, and I guess the problem is Chase kind of brought up is that what are they going to pay for that? It's going to be cost prohibitive or loss leader, because those NFL games are, I think, like $1 billion. I mean, it's ridiculous what they get for that. So,
yeah, and I think that Amazon paid like $1 billion just for Thursday night games.
Yes,
you know?
that's what I said. I knew it was there somewhere. So, but yeah, that's going to be the thing, is how's the bidding's going to go? What it's going to cost? Could it wipe out some of these smaller streaming companies? I guess I don't know. So, but does that make sense, Tim?
Absolutely. And then my quick question is, so I started with my own children and years ago with my grandchildren. I start with a little lump sum, and I put about $500 a month into an account, and they're conservative stocks. It's ITOT, IJR, BEU, things like that. I should just ride that out, especially on the kid stuff, because eventually history shows we'll correct ourselves eventually.
Yeah, that is true, but you do want to. It sounds like you're an ETF or a fund. I missed that. Is it a fund?
Some of them are funds and some of them are direct.
Oh, direct equities. Okay, yeah. I mean, you still got to watch the direct equities to make sure that you don't have a General Electric to where I was a star and all of a sudden it's a dog. So you want to keep on top of those businesses, make sure they're doing well. If it's a fund, you want to make sure that the manager is not playing loose here and just kind of selling things, and look at the turnover rate in the fund to see what that is, and also to be careful of other people redeeming their shares in that fund. Fund manager has to sell off positions that you don't want to sell off. We're not big on funds for that reason, because you're paying a fee for that, but because you're pulled in, you get to pull back, like we'll say yesterday, not a big pullback, but and people start cashing in. Well, if the fund manager doesn't have a lot of cash, he's got to start selling positions on the downside. Can't weather the storm. So we're not big on mutual funds for that reason. All righty?
Awesome, gentlemen. Enjoy the rest of your day. Thanks for your information.
All right, Tim. Thanks for calling. Have a good one. Bye-bye. All right. That does open the phone line, 833-288-0973. Again, that's 833-288-0973.
I was just thinking I probably should have told Tim while I was on the phone there, but he said, I love listening to your show when I get the chance. Is Tim, if you're still listening, and our other listeners, it's not just live. We do record it, and it is podcast on our website. So, if you have some free time throughout the week, or maybe even on a Sunday afternoon, you can just go to smartinvesting2000.com. Again, our website, smartinvesting2000.com, and go to our podcast section. You can check all the old shows that we have there.
It's right. I think it's on right in the page. I think on the top,
right on the front. Yeah,
right in the front. Can't miss it. Just click on that, and you go to different places there. All right, let's go out to San Diego and speak with Lynn. Lynn, you're on the Smart Investor, Brent and Chase. How can we help you?
Okay, I'm thinking of buying Williams Company, which is a energy company, and they're basically with natural gas.
Okay. And what'd you see about Williams Company that you thought, this might be a good buy? What'd you see that?
Oh, a friend was telling me about it.
Okay, good. Okay. Well, let's take a look at Williams Company. Symbol is WMB. They are in the oil and gas midstream, as it's called. Not much on the short side here, only 1.8%, 87.5% institutional owned. PE ratio 27.4. That is more expensive than the industry at 22.4. Price to sales 4 versus 1.2. Price to book value 12. Now the industry's at 51, so that's a positive there. Price to cash flow is expensive 10.3, also higher than the industry at 7.7. But you do have a good PEG ratio of 3.3 versus 12.2, and you do want that PEG ratio lower, so that's a positive there. Look at the earnings over the last year. They're up 34.7% when the industry was down 18.2, so that's good. They do pay a nice dividend, 4.9%, but even the industry's at 5.7, so it's nice to get nearly a 5% dividend. However, it shows they use 129% of the earnings to pay that out. That is over the last 12 months. That could change going forward as they see, hopefully, earnings increase here. We do see on the balance sheet a current ratio of 0.7 versus 0.9. That's a little bit concerning there. What's more concerning is debt to equity is 2 versus 1.4. So you've got a lower liquidity position for the company and higher debt. That is not a good combination. We do see a net profit margin of 14.6 versus 6.2. Return on equity a little bit on the low side, 13.9. I like to see that at least around a 15. Chase?
Yeah, so looking at the company again here, Williams Companies, the current price is $35.03. The 52-week high, $37.97, and the low, $23.98. Year-to-date, it's up 37.9%. Obviously, that's really strong against the S&P and broader market, which is down now 14.2%. But to be quite frank with you, I thought it was going to be higher. Because natural gas has just skyrocketed. And it's a good-sized company. I thought I hadn't heard of Williams Companies, but it's about a $42.7 billion market cap. Now, going forward to December 2023, I do see estimated earnings per share of $1.69. That would give us a target sale price of $28.05. So, unfortunately, the company still looks to be a little bit expensive. I think there might be other opportunities out there that is going to be more enticing. I have seen some other natural gas plays that I think have better valuations.
And Lynn, that's what I was thinking as well when you said that. You're same thought I was on. Like, I'd like to find a natural gas company because they seem to be increasing more than oil has. I know there's concern in Europe with natural gas. I just don't know what our government's going to do to mess up the national gas situation. But this one, it says oil and gas midstream. So you're not getting a pure natural gas play here. As Chase said, I think I'd rather try to find a pure natural gas company. You can look at this company here, Williams Companies. I would imagine that they have, we'll just call it 50-50 oil, 50% gas, maybe less or more, but you want to know that. But it's not even worth looking at because it's above the target sell price. So
and sometimes I will say I have seen where they're in that industry, but they do just the gas. So that is one thing you do want to understand is just because it says that's the category, there may just be 90% natural gas, but that's something you want to understand as an investor. And I mean, it is crazy. It just I tried to find it real quick, but the Asian and European natural gas prices, it looks like started the week at about $35 per million British thermal units, which is how you calculate it. That it's about $8-9 in the United States. I mean, it's a huge spread there, which I think is really benefiting these companies. And I do worry a little bit that this natural gas crisis over the next few years will become resolved. And these natural gas companies, we've seen this before with like oil companies back in 2015. Is oh my gosh, these oil companies, oil's gonna go to $300 a barrel. You know?
I know, you gotta be
and
careful.
then it falls off. I worry that the same thing's gonna happen with natural gas. That in Europe right now it's at $35. Oh, maybe in 3 years from now it's gonna fall back down to maybe $10, and all of a sudden that profitability falls off a cliff.
In the back of my mind too is the war in Ukraine. You don't see that on the news anymore. But if something were to change on that to where it was resolved, I think you would see natural gas drop a lot. So that's the other thing too. You got to remember is that things can change. And I used to see it like every day on the headlines or in the news, something about Ukraine and Russia. This past week, I don't think I saw anything on it. Yeah. So be careful of that. That's one of those things that are out there. You got to remember that could change, and all of a sudden your great analysis was destroyed because Russia decided to come up with some type of agreement. So, all right, Lynn.
Okay, that gives me a lot of information. I really appreciate it.
Well, great. Thanks for calling. You have a good Saturday here.
Okay, you too. Thank you so much.
You're welcome. Bye-bye.
And it is so hard because I remember back in 2015 looking at oil companies, and you would look at it in the valuations, and the forward PEs looked so attractive.
Yep.
Because there was that analysis that oil prices were going to remain elevated and these companies were going to keep raking in these high profits. And all of a sudden, boom, oil fell off the cliff. Those companies went from making money to losing money, and that forward PE, it was no longer material. So you couldn't even generate a target sell price. So that's one thing about commodity companies you have to be very, very careful of, is that the numbers, the earnings, the sales can all look great, but it all hinges off that commodity price. Yeah,
and that's what you got to be. And you want to buy something when nobody want to buy it, because we bought our energy company when nobody really wanted it. I think it's off our buy list now. I think it's in the whole category now.
It's still in the buy category, but the price is now above the buy price.
Buy price. There we go. So, but all right. Phone number is 833-288-0973. That's 833-288-0973. Let's go talk to our financial planner, Harrison Johnson. Good morning, Harrison. How you doing this morning?
Good. Good morning, guys. How you doing?
Good. How you doing?
Good.
Good.
Doing good on a nice Saturday morning.
Yeah, and today we're talking about, and this is very good, how interest affects pensions. So interest rates affects pension. Why don't you explain what you're talking about there?
So some pensions are based on interest rates. Not all, but some of them are. A pension is what's called a defined benefit plan, as opposed to a defined contribution plan like a 401k would be. So the defined benefit is the monthly income that you are supposed to get during retirement. So $9,000 a month for life or whatever it is. So you're entitled to that income regardless of how the market performs, unlike with a 401k, where you can see the balances go up and down on a day-to-day basis. So some defined benefit plans have lump sum options, which means you can take a large payment up front instead of that monthly income, and then you take that lump sum and roll it into an IRA, and then it just forms like that. In many cases, the amount of that lump sum is going to be based on interest rate. And when interest rates are low, the lump sum is going to be higher because it is assumed that a larger amount would be needed to generate a similar level of income as that defined benefit amount is. So what this means is a lot of people have been looking at their lump sum pension amounts in the last few years, and they were quite large, meaning it would be more attractive to take that lump sum and then invest the proceeds versus taking the monthly income. But now we're starting to see interest rates go up, and what that means is it's possible that, one, the lump sum amounts could be going down, and two, it might be more attractive to take the monthly income. Now, I say might be more attractive because in many cases it still does make sense to take that lump sum and keep control of the money, invest it how you want, withdraw what you want when you want, do Roth conversions, keep the money in your family. So there's a lot of benefits that come along with taking that lump sum. However, these increased interest rates are going to have an impact. So if you're someone with a pension that's planning on retiring soon, you're going to want to take another look at that pension and see if there's any changes in those amounts, because it could change how you should efficiently transition into retirement.
And Harrison, this is something that people don't realize. Like, oh, I'll just take the pension and they'll be fine. Sometimes I don't think they realize they have other options.
Yeah, I mean, and again, those options are constantly changing. It's not just interest rates; it's your age, how long you've been working at the company. Some pensions are linked to the market and do better or worse with that. So, just because a year and a half ago you were planning on retiring, now that could be totally different. That doesn't mean you can't retire. It just means that, as you said, there are different options, and now maybe one of those options is more attractive than what you were originally planning on.
Right, and this is all part of the financial planning side. You got to look at that and why retirement planning and financial planning is so important, so that you can make the right decisions and not like, oh, I retired, I shouldn't have retired too early.
And the hard part I see too, or that I know we talk about, Harrison, is a lot of times people look at the pension, they're like, oh, great, and then they forget to think about their spouse.
Yeah.
And because there's so many different options, and I know we've talked to people in the past who are like, I don't know, I have like 5 different options. I don't even know what they mean, you know?
Yeah, single life, joint life with 50% survivor, period certain with return of contributions. There's all kinds of different options in the actual monthly income amount. And then, you have your lump sum amount. And again, usually I favor the lump sum amount, and in many cases depends on that payout ratio of how much income you could get relative to that lump sum amount. But, you have to remember a pension is essentially annuity. And when you retire and you make that switch to, okay, I'm going to get monthly income, well, you're essentially giving up all of that lump sum money. It might be $500,000, could be $1 million, whatever it is. So you no longer own that. You own monthly income for whatever term you choose, kind of like Social Security. And then when you die, there's nothing left.
Yeah, and that'd be. And I'm sure this has happened. Somebody dies, 3-4 years later. Like, wow, they left a lot of money on the table there.
Yeah, and they might leave a spouse or kids who then don't have any recourse in order to get any of that money back.
Right. Well, that's why we do financial planning for people, so they understand all their options. So, Harrison, thank you very much. Enjoy the rest of Saturday, and we'll see you on Monday.
All right, thanks, guys. We'll see you on Monday.
All right, bye-bye. All right, again, that's our financial planner, Harrison Johnson. Give him a call at the office, 858-546-4306. That's 858-546-4306. Or go to the website and send them a message as well. That you can get a free consultation with Harrison. Website, again, smartinvesting2000.com. That's smartinvesting2000.com. All right, phone number's here, 833-288-0973. That's 833-288-0973. Let's go down to Bonita and speak with Greg. Greg, you're on the Smart Investing Show with Brent Chase. How can we help you?
Okay, Greg, good morning, guys. Well, I just like your take, if I can get it, on AFCG is the ticker, Alpha Charlie or Alpha Frank Charlie Gamma.
Okay.
I don't know what the AFC stands for. It's a REIT sector, classified as a REIT. There was an article on Yahoo or somewhere about a month ago, and I added it to my watch list. I don't know if I should leave it there. It's a little too young for me, but
right.
I just wondered what you thought.
Okay, so I guess you don't hold it yet, kind of looking at buying it, correct?
I would hate to miss it, let's put it that way.
Okay, all right. We'll take a look at here, and I know Chase is going to have some time to kind of find out what type of REIT it is. I do see it's a REIT called Specialty. Not much float here, 1.4%. Not a lot of institutional ownership either. 42%. You got a good PE ratio of 8.7 versus 35. Price to sales 5.3 versus 7.2. Price to book value 1.1. The industry is not material, so that's a positive there. Price to cash flow also in line, 18.9 versus 20.1. So all that looks pretty good on the valuation sides. Now we do see some crazy numbers here on the earnings per share over the past year, up 491%. Sales up 761%. Those numbers scare me as opposed to make me feel comfortable, but you got to look into it a little bit deeper. We do see a nice dividend here as well, 12.6%. They use 97.6% of their earnings to pay out that dividend. We do see debt to equity looks very good, 0.3 versus 4.2 for the industry. Net profit margin 59.2 versus 20.4. Again, sounds like a good number, but almost too high that it worries me. Chase, did you find anything on this company, and give us some numbers going forward?
Yeah, and I did find the AFC. It's Advanced Flower Capital is what AFC stands for.
Oh.
And what this company does is they actually originate, structure, underwrite, and manage senior secured loans and other types of loans for established cannabis industry operators in states that have legalized medicinal and or adult use cannabis. So they're in the cannabis space. I kind of surprised they're structured as a REIT since they do more of the financing rather than the owning of, let's say, grow sites or the distribution center. They don't own land or anything like that. They do the financing. So I'm a little surprised they're more structured as a REIT here rather than just a company.
Right.
But looking at the business here, I got all these different tabs pulled up because I was intrigued by the company. But yeah. Current price here for AFCG, it's $17.84. The 52-week high is $25.50. And the low was $14.90. Year-to-date, stock's down about 16.7%. It is a smaller company as the market cap is $354 million. When I look at the numbers going forward, I'm kind of surprised. There's 4 analysts that do have projections, which for a company that size is a decent amount. But I see here the estimated earnings per share is $2.74 for December 2023, and that's about a 20.7% growth rate off of 2022 numbers, and 2022 numbers have a growth rate of 49.5%. And using that $2.74, we get a target sell price of $45.48. So, I mean, the valuations are very strong on this company. I will say, the cannabis space is still somewhat up in the air,
right?
Where I do worry that there's going to be too much competition. I remember years ago, I haven't looked at the cannabis space because I feel like it's not as popular as it was.
Right.
Where there's
a lot of competition there.
Yeah, but a few years ago when it was really hot, we had people would ask us about it all the time, so we did a lot of reading on it. And I think it was in like Oregon and different places where they didn't have set licenses and it was kind of open. I mean, there's operators that were just hemorrhaging money because it was unprofitable.
Right.
And I worry that if this company's making loans, it says they do it to established companies, but I'd want to know who they're lending to. Because all of a sudden it's like, yeah, we get a great interest rate on that loan, but they go bankrupt, they can't pay back the loan. That's going to be an issue for this business.
Yeah, and I think, Greg, it still comes down to a company like this, you got to understand more about the industry. As we talked about, it was like just way too much supply coming on, too many people doing it. They couldn't make a profit, therefore they would go bankrupt, and AFC Gamma would actually be hurt by that because no one can pay back their loan. So you really got to understand a little bit more what they do. And normally look at the FFO on the REITs, but I think since this doesn't hold property, it's the loans, the FFO doesn't matter. The earnings actually matter here.
Yep.
Yeah. So I can see why you're excited about it. I'd like to target sell price, but I think it requires a lot of research. I'm not that excited about it because it's just
dividend yield 12.6%.
Yeah, everything you're saying that is questionable about it, I agree with, and that's why I'm not so sure. And I think it's at first it's too good to be true, and then cannabis. Yeah, I've dismissed all the cannabis stocks. I hold them in the same regard as Bitcoin, perhaps.
Yeah, well,
at least they have sales.
That's true.
Yeah, they had sales before it was even legal, but I digress.
Yeah.
The thing that intrigued me was the niche it had found, and that it's financing these companies. And I did as much digging as I could without paid reviewerships or something.
And you know what I'd want to see in this, because again, I know that cannabis is not going away. It's here to stay and so forth. But what I would want to see is a big clean out of the whole cannabis system, to where a lot of companies went bankrupt. They're out of the system, because eventually I think this will be a profitable area to be into. I don't know if we're there yet or not. If we're there or close to it, this company could do very well if the industry is not filled with a bunch of suppliers.
Yeah.
Already?
Right. Well, the thing that I was going to say that I found is that, I don't know what all is involved in applying for or gaining REIT status, except, it's a taxable event that they want, or non-event, let's say. And so how did they do that? Well, I don't know, just like you were questioning.
Yep.
But the one thing I found is that the loans they make, the debt that they acquire, is they secure it with the property rights.
Interesting.
The land that the cannabis places are working.
Which could be
so,
good.
Yeah,
but that land, I believe I've heard some outrageous numbers of what people are paying for that land because of
as well.
Yeah.
Yes.
So yeah.
That could fall out just as fast.
Yep.
So yeah, I appreciate your taking the time. I think I'll continue to watch it. It might be at some point worth putting a few bucks into it, but it won't be a full position, that's for sure.
Yeah, and do some more research on the entire industry to see if it's starting to have that clean out effect that I was talking about, because that to me would be a big positive. Because I would like to someday, I think these are here to stay, is buy a good cannabis company that's making profits, doing all the right things, because the demand is there, but just too much supply at this point in time, I believe. Already?
Well, again, that's like this one because they cover the whole market.
Yeah.
It's not just a single company.
Right. But again, they're backed on people paying the loans, and they could, So.
Right. Yeah. Well, that's the big question. They default on the loans. What happens? And so, it's like after the article came out, it was up like 12% in the last month.
Yeah.
But it seems to have tapered off, and that's what I'm waiting to see. These big giant startup numbers that you see, those have to taper off too. Those can't be sustained for long term. But where does it level out? And is $15, $16?
Yeah. That's what we got some more research to do. So I think you're wise to kind of watch it, do some research, and be patient there. All right, Greg?
Yeah. Appreciate your looking into it. Thank you.
All right. Well, thank you for listening and calling. You have a good Saturday.
You the same.
Bye-bye. All right. We got, is it 2 minutes left?
Yeah, it's a mutual fund, so we might be able to address it
let's
real quick.
Quickly go out to Mark in Huntington Beach. Mark, you're on the Smart Invest Show. Brent Chase, how can we help you?
Hey, I love the show. Listen to you guys whenever I can. The fund, I know you're limited time. The fund is primarily my Roth. Mostly this fund, which is the Pro Fund Ultra NASDAQ 100. It's a leveraged fund. I think it's closed now. I've got quite a bit in there, and I know it's the last 8 years done well, but last 12 months I've been hammered quite a bit. I think whenever it goes up 10%, I get 20%. When it goes down 10%, I lose 20%. So I'm a bit concerned and want to know what you think about it.
Well, we don't have a lot of time. We've got about a minute here. It's a leverage fund. I think you said it's a growth fund. I would definitely say stay away from that because you're leveraging growth, which we don't think is going to do well over the next couple of years here because of rising interest rates. I would look more for the quality. I know you also mentioned about the Growth Fund of America, another company that has a lot of growth into it, growth companies.
Yeah, and I just would be really careful on the NASDAQ. I mean, I don't think we're going to have an exact repeat of the tech bust, but I think we could see something similar where growth really struggles after this huge run-up that we've seen. It's been somewhat reminiscent of that kind of 1990s type bubble. Not to the same extent, but I do worry that growth could have a collapse. And, I think the NASDAQ maybe goes down quite possibly 30, 40%. We've already seen 30%. That means you're double leveraged on it. That's going to cost you 80% at the end of the day. Yeah. That could be very, very dangerous. So I don't like those leverage funds. I don't like the growth investing. As you know from listening to the show, we're value investors, so it's too risky for what we do. And
I think you could be in a range for years to come where it goes up 20, 25%, then back down. And all of a sudden you look at it from 2025, like, gosh, I've made almost like no money here. As Jay said, too, the leverage on that fund, it's going to magnify those losses.
Yes, I appreciate that. And I know you got to go, but the Investment Company of America over at the American Fund would be a better choice, right?
They still have, and I looked at somebody for that just came over, and they had, in my opinion, too much on the growth side. A lot, I think like 25% was like in 5 companies, I believe. Yeah, and it's Microsoft, Tesla, Amazon, they make up about 15% of the portfolio. Those are all overpriced. Gonna be a little lenient here. I mean, Facebook, Netflix, Google, they're somewhat relatively okay priced tech companies now. Right. They're in there. United Health in there, they're not bad, but the Tesla, Microsoft, Amazon making up 15% concerns me. I think those are still very, very overpriced. Yeah,
exactly. Well, thank you so much. I know you got to go. Appreciate your help.
Okay, Mark. Well, thanks for listening, and you have a great Saturday. Talk with you soon. Bye-bye. All right. I was going to say that opens up the phone line, but it is not opening the phone line.
We can take a call for 20 seconds.
For 20 seconds. We're going to do a call in 20 seconds. No, we can't. So, but a great show today. A lot of good companies, a lot of people to talk to, and different things that hopefully you learn from different things on how to handle. I was very happy to talk about the cannabis side because that's something that I think could be something down the road. I just don't think we're there yet.
Yeah, I think it's going to take some time.
Yeah. Well, there is the closing bell. Thank you for listening to the Smart Investing Show. It is for informational purposes only and should not be used as investment advice. If you'd like to discuss in more detail your investment needs or have other investment questions, feel free to call myself, Brent Wilsey, or Chase Wilsey at 858-546-4306. That's 858-546-4306. Or visit our website, smartinvesting2000.com. That's smartinvesting2000.com. And for more daily educational information on investment tips, go to our Facebook page, Smart Investing with Brent and Chase Wilsey. Thanks for listening to the Smart Investing Show. We'll be back next week right here with the Smart Investing Show.
So amusing to think